Right, welcome everybody to today's MT Predictor Training Room. While I read the risk disclaimer out, could you just let me know by clicking in the question and answer box, which is off to the left-hand side of your screen, whether you can hear me okay and whether you can see the chart okay. Just want to remind you that all examples in this training room should be considered as hypothetical. No trades are actually taken. They're just shown for illustration and trading purposes only. Remind you there's a risk of loss in trading and investing. Put another way, all professional traders know and understand, but more importantly, accept that losses can and will and do unfold. It doesn't matter what trading approach you take, there always will be losing trades. Right, okay. Where to start today? Right, there's been quite a few questions come in over the last week, and what I'd like to do today is do a bit of detail on those questions that have come in. So the main ones were from Mohan and from Cole down in Australia. So that's Colin, I think. So I want to go over these questions because I think they help. They'll help a bit of background about MT Predictor and what we do. If you're new to MT Predictor, I'll just remind you that we're not a black box system. We don't just blindly take our trade setups as if it's a mechanical system. We don't perhaps even take them in conjunction with our MTP trend color. The reason we don't do that is because markets are random half the time, and we'll come on to the importance of that a bit later as well. So how do we then decide on how we take trades? Well, as we'll see as the webinar progresses, we decide on taking trades on whether the larger degree picture is clear. And for using the larger degree picture, we go out to the higher time frame charts. And we'll see that in an example in a minute. But first, just want to go over our setups that we have in MT Predictor. This is our standalone program. We also have add-ons for NinjaTrader 8, as well as Pine scripts for TradingView as well. So Mohan asked a couple of good questions on a bit more detail on exactly what our trade setups are and a bit of the background for them. If you want to find out a bit of reading yourself, if you go to our MT Predictor website, if you come down to our pricing section, there at the start, obviously you don't need to buy because you're customers anyway, is the introduction to MT Predictor PDF, this one here. So if you click on this, this is about a 50-page document, I think something like that, 45 pages, that will go through our setup. So it'll go through what the TS1 is, TS2 is. So it'll go through in detail exactly what the setups are. Which is some good reading for all of you from time to time as well. But what I wanted to do is just go over a couple of them just to show you some background about what the setups are. In the early part of MT Predictor, the one thing I wanted to do is look at Elliott wave patterns. But I also knew, I mean, this is going back 30 odd years now, so I started following the markets in 1987. So what I wanted to do is use Elliott waves because that had the tempting idea of being able to project or anticipate where markets are going to go. So I looked at Elliott wave patterns, but it soon became apparent that Elliott wave in theory was great, but in practice wasn't, because what happened is the markets broke down. They broke down because the markets go random. And this is why I developed my unique isolation approach to Elliott wave. If you want some more background information on that, what you can do is if you go to our resources tab, if you come down to trading Elliott wave, and here there's a bit of background on the problems faced with Elliott wave analysis. You can click on that, you can read through that and actually see why I believe that markets are random half the time. And if you go on to next, you can then see a bit of background about how I do, or why I developed the isolation approach to Elliott wave. But the reason I'm giving you that background is because in Elliott wave terms, the most simple pattern or the easiest pattern to recognize is the simple ABC correction. So if I have a look at the NQ from yesterday, this is a day session only chart. If I look at this TS3 setup here, this is what I mean by an ABC correction. So if I right mouse click here, do Elliott wave intermediate, can you see what the software's found? It's found 3 swings, an A, a B, a C, where the wave C has ended at one of our WPT or wave price targets, which are Fibonacci clusters. So this is the simple pattern that I started with. In other words, the market was making a move. It then made a 3 swing, an A, a B, a C correction, to then terminate in one of our zones there. The market trend was then going to continue, and that gave you an opportunity to uncover a trade setup. The trade setup was a move to new extremes in the original direction. So this was then to carry on down because the previous 10 was down. Therefore, the trend can carry on down, and that allowed you to then take a trade in the trend direction after an ABC setup. Remember, we use position sizing. Obviously, this is the far too big for our 2% of a sample $20,000 account. So you'd probably be using the micro if you're trading this. But the idea being is that when you're wrong, you lose one risk unit. When you're right, you hopefully have profits that are large. And that's an important point to remember when we come on to a question from Colin later on. Hopefully the profits are large in relation to small initial risks. So that's the basic pattern we started with. But it soon became apparent that even though you're just looking at, you see we have trends here. We have trend lines that connect the pivots. So a move down, then a simple ABC correction. Now this is all well and good, but not all ABC corrections had this simple pattern. Because if I go to the ES, here's another ABC correction. Again, there's your A, B, C. Ignore the MTP trend color. I'm just looking at the pure pattern. Here's the ABC pattern again. So it's the 3 swing corrective pattern. You can see it is a correction relative to the prior trend going down, but it wasn't found by the software because of this pesky little pivot here. So can you see that if I go back to the NQ, here you had one continuous pivot, then an ABC. But on the ES, there's the ABC, but here's the previous swing. In other words, this wave C was bigger than that last previous swing. So that's why I developed the TS4 setup, because the TS4 setup is an ABC correction that is a slightly larger degree. In other words, it's slightly bigger, because if I place the analysis on here, can you see how the software has now done this ABC in relation to this prior swing down? So in other words, the corrective high here, i.e. the end of the wave C, is terminated below the start of the prior sequence, which was here. See, so it looks basically the same as we had here. There's the swing down, there's the ABC, there's the end of the wave C, there's the start of the sequence. So the same kind of pattern, but it's just a slightly bigger scale. And we do that to then make sure we still can find the ABC, but to get rid of this pesky little pivot. If it unfolds there. So Mohan, that's the basic difference between a TS3, which is a basic ABC pattern, and a TS4, which is an ABC pattern of a slightly larger degree that basically can take account of when you get a little pesky minor wiggle like this. So it takes a slightly larger previous swing. So that's the only difference between TS3 and a TS4. We have some other ones. We have a TS2, and what I'm going to do is, where's a good example of that? Let's go to the ES from this morning. So a TS2 here is again our ABC correction, but this time on a smaller degree. So rather than a larger degree like the TS4, it's a smaller degree correction. See, there's your ABC again. That smaller degree correction unfolds as part of a wave 4. So if I right mouse click here, do Elliott wave intermediate, can you see here's our sequence? 1, 2, 3, 4, wave 5. So the wave 2 is designed to get you in at the end of the wave 4 to then catch the wave 5. Again, ignore the MTP trend color because I'm purely just simply looking at pattern here. So this is the TS2. The TS2 is designed to catch the end of a wave 4. So if I do the edit wave, if I clear that all off again, I do the edit wave minor. Now if I perhaps do the edit wave intermediate here, see there's your wave 4. So that's the TS2. It's a lesser degree or a minor ABC correction in a wave 4. By process of deduction, if I go back to the ES from yesterday, do I want the ES from yesterday? Or is it the YM? The YM. So by deduction, the last one that's left is a TS1. Now that's probably not a good example, but Colin, bear with me because I'm going to come on to using this in a second. If I go back here and perhaps look at this TS1, the TS1 is again a minor ABC, so it's a minor correction, an ABC again, but that minor correction unfolds as part of a wave 2. Well, actually, it can be a wave 2 or it can be a wave B, and that's the question that Colin asked, which is what we'll touch on in real detail in a minute. I'm not going to do the edit wave pattern here because we haven't got a great example, but if you can imagine, that's where we start the sequence. The initial move is wave 1. The ABC correction down there is wave 2, that then carries on to potentially a wave 3. Again, if you want to look at this in a bit more detail, where is that one there? You can go to resources. If we come down to edit wave theory, there's a bit of detail there, so you can look at the edit wave C, you can look at edit wave 4, you know, all these different edit waves, they're there underneath resources, edit wave theory. So it shows you what the basic pattern is. If you go to resources and then edit wave rules, these are the basic rules and guidelines that are basically summarized that basically the edit wave pattern should basically follow. Again, using MT Predictor, you don't need to be an expert at this. I want to stress is that we don't need to be an expert in edit wave patterns. It's just for you guys who've asked, it's giving you a bit of background information so you can do a bit more research yourself to become a bit more familiar. Edit wave is fairly simple. It only has 3 rules in that wave 2 cannot go part the start of wave 1. Wave 3 is usually the longest, and wave 4 cannot retrace into the area of wave 1. They're the basic 3 rules that edit wave has to obey. There's also some general observations. For example, edit wave 3 is usually the strongest. So if you click on that, you can see the pattern there of what an edit wave pattern should be. And these are all the other observations. They're not generally rules. They're basic observations about what typically happens. Another one that we like is that edit wave 2 usually unfolds as an ABC, which is this one here. And what we like about that is because if you combine edit wave 3 is usually the strongest with edit wave 2 usually unfolds as an ABC, what you get from that is, if you look at trading the wave 3 here, what you get from that is this pattern here, which is our wave 3 or W3 trade setup. So that's why, again, you can look at this in a bit more detail yourself in your own time. So we have the edit wave, the W3 or wave 3 trade setup, which is designed to catch the wave 3, and it gives you reasons why we like that and the guidelines that it tends to follow as well. So that's all background. So Mohan, hope you've it's given you a bit more to work on and a bit more to look at for a bit more background on what we do and why the patterns are what they are. Now that's great in theory. Now this comes on to Colin's question, because if we have a look at the YM from yesterday, okay, I just want to go through this just to build the pattern up. Is that, as I said earlier, when we trade MT Predictor, we're not looking at trade setups in isolation. We're not looking at them in just with our MTP trend color. The reason we don't do that is we know markets are random half the time, or probably slightly more. And this is a real critical point. This is the main thing that I think will sort out on whether you'll ever become a successful trader, is because there's so many amateur traders. In fact, as human beings, we always want to know what the future is going to bring. We want certainty. We want to have 2 + 2 = 4. But in the markets, we simply cannot have that. It's as simple as that, is that no matter how good analysis we do and whatever we do with putting trade setups together, the markets will suddenly go the wrong way for no apparent reason at all. Now, most people, this really just sort of does their head in, so to speak, in that they can't cope with that. So what I really try to work on to understand is that, and accept, that's the more important point. If you accept that markets will go random about half the time, then it doesn't matter if the pattern breaks down, because you know it's just a natural part of the market basically falling apart. And then trading comes down to a simple idea of simply finding trade setups where if the market is wrong, again, this is not a good setup because it's not ideal, but what I'm saying is if you're wrong, you then lose. So in other words, you lose what we call one risk unit. Again, we use our position sizing based on our sample or our account size. Again, you can change the account size depending on your account size, but we risk 2% of whatever your account size is. And then over time, we're looking for trades where the profits are large in relation to the losses. And this is what trading should be about. It should be about profits and losses. It shouldn't be about pattern and trying to predict the future. I'll say that again. It's about profits and losses, i.e. what goes into and out of your bank account. It should not be about market pattern, because market pattern doesn't do anything, because it's never going to be 100% correct. And that's so important to understand. So how do we decide on what trade setups to take? Well, for this, we go to the higher time frame chart. This is what we do every week. We talk about this week after week after week after week. I'm just going to go back in time on this ES chart. And here we are looking at the higher time frame chart. The higher time frame is between 3 and 5 time frames higher. So on a 3-minute chart, you go out to the 15-minute. On a daily, you go out to the weekly. If you're trading, say, 15-minute Forex, you go out to the hourly. What we're looking to do is that, yeah, you can see I've got the scanner here, but we're not looking to use that. What we're looking to do is we're looking to project in advance our decision point levels. So here, the market is retracing back to the previous pivot. So we know that we take the previous pivot. Again, there's webinars in the member section of the website that will show you which pivots to take. Fairly easy guidelines for you guys who've been with us for a while. I won't go over them again now, but you can go and review those if you wish. So as the market is retracing back against this pivot, we use the previous pivot there. It's the last swing into the higher low, isn't it? Can you see how this is on the chart in advance? This gives you an area of potential resistance. So what we're looking to do is, if I turn trading mode off, we're looking to see whether, if, not when, because the pattern could break down, but if the market gets to this level. As you can see here, that caught the high of the day absolutely perfectly. If this happens, we then deem the larger degree trend is down. Therefore, we look for trades on the short side. In other words, the market trend is going to go down. So here we had a buy setup. Here we had all these buy setups. We would be ignoring these because the large degree trend was down. And obviously that's helped by confirming by our MTP trend color. Where's it going down into? Well, again, if I go back to the 15-minute chart and I use our trading mode again, where's it going into? As the market's going down in the original direction, we take the previous pivot in the same trend direction. So it'd be this pivot here. This would be an area of support. If I turn trading mode off, the market went down. There was the DP. If I go back to the 3-minute chart, look how that worked yesterday. Sometimes this is absolutely amazing. So on the YM yesterday, the DPs caught the high absolutely perfectly, the low absolutely perfectly. That's where the market started to reverse again and go on the way up. Frustratingly, there were no trades in between that. That happens sometimes. So what we're looking for is, let's go to the ES from this morning. This is a 24-hour chart. So I want to show you now with one where there was a trade setup. I'm going to do exactly the same. Go back to before this pivot low unfolded. We take a DP off this pivot. This would have been on the chart in advance, okay? So that would have been there before the market got there, preparing you in advance. If we go down to the 3-minute chart, so this would have what it looked like before. There it is. There's your DP level. So this is what I want to get you guys to do. I want to get you guys to be ready in advance. So let's see what happens as the market goes down. There it is. It's now in the level. It then reverses with a buy setup. This is where you can check your MTP trend to be either grey or blue if you're looking for a buy setup, grey or red if you're looking for a sell setup. But can you see how now we're at higher time frame support? We've now got a shorter term trade that's agreeing with the higher time frame. In other words, it's coming in at higher time frame support. So we right mouse click over the blue buy bar, do analysis. That then gives you the trade setup. We go forward a bit. It then is taking you into a long trade that's starting to go with you quite nicely. At this point, we don't know what's going to happen. And this, Colin, is the important point that I want to come on to detail your question in a minute. But at this point, we don't know what the future will bring because the markets can go random again. We can get situations where you can have perfect reversals at our higher time frame support and resistance. Excuse me, and we get no trade setups, which is frustrating. Or you can have times when, if you have placed the 15-minute DP on the ES from yesterday, we can have times where the DP wasn't reached and we then got a trade setup. So here we got the trade setup, the DP wasn't reached. It wasn't an ideal setup because it was against our MTP trend as well, even though the trend went with you or the market went with you. So you can have this kind of frustration where you miss a trade setup because it wasn't ideal, or you can have this kind of frustration where you caught the highs and lows absolutely perfectly, but you didn't get a trade setup because you're waiting for the times when you get this situation, when you get a trade setup that comes in at your hard time frame support and everything comes in absolutely great. If we turn training mode off, this is what the market did. It went up to the first target. And this is the important point. This is the whole crux of successful trading, is that when you have a successful trade, look at this R number here. We're looking for trades that have profits that are large, not just in dollars, but large in relation to initial risks. Because when you're wrong, and you will be wrong, it doesn't matter what trading approach you take. It doesn't matter who you follow, what you follow. There always will be losing trades. Is that when you're wrong, the loss is -1R or 1 risk unit. But over time, we're looking to have trades that when you're right, the profit is large, but not just in dollars or whatever currency you're trading, but large in risk reward units. So you can see here now with this profit at 6.5R, you can now have 6 losing trades and you're still up. This is the whole key to successful trading. Large profits and small losses. So this is the key to MT Predictor, and I believe the key to successful trading. It's not trying to project where markets are going. It's not trying to have perfect setups the whole time. It's not even trying to have a high percentage of winning trades. It's about purely and simply that when you get a setup and the pattern's clear, the loss will be small when a loss comes through and the profit's large when the profits come through. So, of course, this then leads on to this question that Colin asked, which I think is a brilliant question. Okay, Cole, are you ready for this? So this is what we have. Here we have a perfect high. It came down beautifully. Here we have a perfect low. It started to reverse beautifully. So can you see that now, as the market's starting to go up, now I know this is towards the end of the day, so don't please worry about this, is that all I want to show you is that because the market trend is now up, coming off a higher time frame DP, in other words, the picture is turning clear here, the larger trend is now up. This is confirmed by our MTP trend color. Therefore, you're looking to take trades in this up direction. So can you see how now this TS1 trade setup is now a good one to consider because it's in the new trend direction. In other words, as we had on the ES here, the setup came in at the higher time frame support. In this circumstance, oops, it's YM, wasn't it? In this circumstance, it's coming just after the higher time frame support, but the higher time frame support was good, clear, and a good reversal at that level. Therefore, the pattern's clear. Therefore, this would be a good one to take. Now, here comes the question that Colin asked. This is the initial move up of this low. What we do with Elliott wave patterns is we draw a line in the sand. So effectively, I draw a line here and say that's where the pattern excuse me, that's where the pattern becomes clear. So this is why I developed my isolation approach, in that I don't worry about what the pattern's done before. Here, the market pattern is starting to become clear because we're reversing off higher time frame support. The initial move up here is followed by initial correction. If I do Elliott wave intermediate here, this then gives us a area of where we have support. This is where our TS1 comes in. But can you see what it says? It says wave 2 or B. In other words, at this particular point in time, we do not know whether this is a B, and then we're going to get a wave C. In other words, if I use our WPT up, I do wave C. I start with that. We don't know whether the market will go into our wave C targets. In other words, whether this is going to be an A, B, C before the market carries on down again, or, and this is the question that Colin asked, whether this is going to be a wave 2 and then the target is the wave 3 WPT. So it's whether it's going to be, and there, whether the market is going to go to that level to then hit the wave 3 WPT. Isn't it, Colin? That's the question you asked. So at this point in time, how do we know whether the next move is going to be a wave C or whether it's going to be a wave 3? Why is that important? Well, because if I place the analysis on here now, if this goes up to the wave C and then rolls over, the profit will be 3.5 times the initial risk. Nice profit, but 3 times the initial risk. But if it goes up to the typical wave 3, so that one's slightly in the wrong place. It's slightly in the wrong place because when I clicked on it back here, I think I missed the bottom. So sorry about that. But if it gets up to here, can you see how suddenly it's gone up to 8R? So if it was a wave C, it would only be 3. If it's a wave C, it'll be only 3. If it's a wave 3, the profit will be much larger. In other words, 8R. Here's the kicker, Colin. What we have been talking about in previous webinars, in fact, you can review these in the recordings, is if we now go to the higher time frame chart, here's the last swing down to the low. So if I right mouse click and put that on, just going to take that off, that was the next higher time frame resistance zone. So if you're using your higher time frame analysis, what you could well do as well is you could say, well, actually, this is going to be my higher time frame target. So rather than coming out as a typical wave 3, I might want to run all the way up here for a potential 12-hour profit, because that's the higher time frame chart. That's the higher time frame resistance area. So that increases your profit even more, which is obviously great. So this is the dilemma you have when trading. And this is the thing that I think most people will struggle with, in that because the markets will go random, in other words, the market pattern will degrade at some point, and you don't know when that's going to happen. If we did, we'd all be billionaires, but we don't. Then you'd know whether the market is going to carry on up again. So at this point, you do not know whether it will be a 3-hour profit, an 8-hour profit, or a 12-hour profit. And I'm afraid this is just life. I think the people, the gurus who try and say, yes, we know this is going to be this or this is going to be that, they've never had a trading experience. Based on the last 34 years, I'm afraid this is the way markets are. This is the reality. So how can you cope with this? Well, what I've been talking about over the last few weeks is I've been trying to get people to look to run their trades further. Okay, because if you look to run your trades further, you then have the big profits. So if this was a 12-hour profit and this was only a 3-hour profit, you divide 12 by 3, you'd have to make 4 of these trades to get that one 12-hour profit, wouldn't you? So in other words, it's much better to try and to have trades where the profits are large. But the kicker is, because the markets can go random, in other words, the pattern can break down, is that it will only go up to these higher levels, these further out levels, less of the time. So you have to have a real soul searching on whether you want to try and go for the bigger trades and have less of them unfold, but when they do, have a bigger profit, or you want to have a smaller profit and then rely on actually having more trades that work out as anticipated. Now, over time, I think what I've found, and this is what I keep trying to get you guys to do, is better for your bank balance if you look to have the bigger trades that unfold like this, because if you have the bigger profits, it's then easier to then make up from the losses. But the kicker is, because that does not happen that often, you'll have quite a few times when the market will simply not do that. And this is a good example, because if I go out to the 24-hour chart and I go back to that same TS1 there, can you see what the market did? It only went up to this level here. There you go, there. It only went up to the first target there and had a 3-hour profit before the market started to come down. So in this example, you never would have got the 12-hour profit. You would have only got 3-hour. And this is the real kicker. This really is. And this is psychologically where the markets will play on your mind day after day after day. Because what will happen is, if you take a 3-hour profit and then you miss out because the market would have gone all the way up to there, you'll be kicking yourself and blaming yourself, and you'll be beating yourself up for doing it wrong. If you aimed up there, and as we've seen in this example, it only came out to there, again, you'll be kicking yourself, blaming yourself because you didn't do what the market did. And this is where the psychology of the market will do more damage than anything I've known in elsewhere, and that it just plays with your mind. In other words, in hindsight, hindsight's easy, but at the time, you don't know hindsight, so you never know what the market's going to do. So the best thing you can do is, like in this circumstance, is then you bring your stop to break even if you're looking to go all up to that level, and look to try and run the trade, perhaps trading with the ATR stop or using a trailing strategy. I mean, you can use that, Colin. Yes, you can use a trailing stop kind of strategy. But at the end of the day, it's really up to you. Is that it's what kind of trader you want to be. Whether you can find it psychologically easier to wait for these bigger profits, or to try and come out with smaller profits. But the problem is, what I've found over the years, if you only ever have 2 and 3-hour profits, it only then takes a couple of losing trades to basically put you back going nowhere, doesn't it? And I think if you end up doing that, your trading will, as I just said, will actually go nowhere. So to be successful, you do have to have these large profits. You really do. But it is so difficult. It is so difficult to achieve. So Colin, hopefully that's helped you. And, in answering your question, you summed it up absolutely perfectly, that this was the perfect setup, is that at this particular point in time, you do not know for sure whether this will be a wave B or a wave 3. You don't know. The best thing you can do is look to perhaps the larger degree trend. So in this circumstance, we've gone out to the 15-minute chart. So you could look at this and say, well, on the 15-minute chart, this is probably not a good example because it's just going sideways. But perhaps in some other charts you look at, if you look at the higher time frame chart, perhaps there might be a clue or more biased towards one direction or another to then help you decide on whether you're going to, on the shorter time frame, look to run it further, or on the shorter time frame, looking to see whether you're going to come out at the shorter target. So that's probably the best advice we can do, is go out to the higher time frame chart to then, if there is a clear pattern, again, this is not a good example because here the market is just literally chopping sideways. It's very difficult in this example to get a clue on exactly how that trade setup would have unfolded without the benefit of hindsight, of course. But in your trades that you're actually taking yourself, on the higher time frame chart, perhaps there might be a more of a clue on what the large degree trend is, and then that will help you perhaps decide when you're on the shorter time frame on whether you only want to come out at the wave C, or whether you want to run it to the wave 3, or perhaps even the higher time frame DP in that large degree trend direction. So Colin, does that help answer your question on that? And Mohan, does that help answer your question on what the patterns are on the trade setups, in particular how we're looking for the difference between the TS4 and the TS3? And everybody else, hopefully that's helped giving you a bit more background information on the chart patterns that we use. Also giving you some background information on the dilemmas that you could have, when we're, sorry, I keep clicking the wrong chart, when we're in this particular pattern, and then how to, over time, perhaps look to trade those the best. So over time, remember, that's what we're looking to try and gauge. Patterns that are large in relation to the initial risk. Timo said, is it worth trading a sideways pattern? Well, if this trade, Timo, on the higher time frame chart, if this sideways pattern had continued and the market had gone up to that DP level there, that higher time frame DP there, if the market had gone up to that level, that would have still been chopping sideways. But on the shorter time frame chart, that still would have made a 12-hour profit. So that would have really been a worthwhile trade. Right, so that's really what I wanted to cover today. So quite a detailed analysis on a bit more background information on what to do. But if you're new to MT Predictor and you're looking to just use MT Predictor at its basic level, the ES from this morning just sums up exactly what we're doing. Is that basically with MT Predictor, what we're looking to do is we're looking to go out to the higher time frame chart. Okay. We're looking at the higher time frame chart. We place our DPs on our chart in advance. Okay. These are levels that are leading. They're there on the market in advance. The markets will not go to them all the time. Sometimes they'll go through them. Sometimes they won't be clear. But what we're looking for is when, not, or I should say if, rather than when. If the market pattern does get to these levels and starts to make a reversal and the pattern's clear, then simply what we're looking to do is take trade setups that come in at the DP reversal or just after, and then we're looking to take trade setups that unfold at those levels. If you're wrong, you'll be a -1 hour loss. If you're right, you're looking to have profits that are large, not just in dollars, but large in relation to the initial risks and to the losing trade. So large profits, small losses. That's what we're looking to do. So this is the basic of MT Predictor. That's all you really need to know. But for you guys who've been with us for a while, we put a little bit of extra flesh on the bones there. Right, are there any more questions? Because we're basically run out of time now. So are there any more questions in this last couple of minutes? Timo says, are the sizes of the DP boxes relevant? No, they're not. Just depends on what previous swings there are. It doesn't, if it's a big box, it isn't more important than a small box. It's just the price, and it doesn't matter left and right. This is why you can grab and drag them left and right. There's no time aspect to DP boxes as well. Of all the research I've done over the years, a lot of people talk about time and timings, but I've found that time isn't as easy or as reliable, as important as price. Price is by far the most important. Do you mean this grey line here, the MTP trend? This grey bar here on the MTP trend? Right, that is quite simple, Colin. All that is when the market gets to its target, okay? So when the market gets to its profit target, which it did there, do you see that? It's got to its profit target. What you can do is then you can look to the MTP trend color or the MTP trend in relation to the strength band, which is that grey band. If the oscillator is beyond the strength band, which is here, then you deem the market is strong. If it's strong, you're looking to then try and run your trade a bit further. If it's weak, in other words, if the oscillator is less than this strength band, when it's reached the target, you only look at this at when you'd reached your profit target. If it's weak, you then look to come out at the profit target. So perhaps back in this YM example here, what you would have been doing is when it reached its target, you then look to see whether it was strong or weak. In this case, it was weak. You can see it's less than the strength band. You look to come out at the shorter term target. But if it's strong, as in this example, it's probably going to go further. So that's where you can consider perhaps using your ATR stop. In this circumstance, it didn't work out very well because the ATR stop would have taken you out there. But nevertheless, the trend did carry on, and that was indicated by the strength. In other words, the market being beyond its strength band. So, Colin, that's how you use the MTP strength band. It's only when you reach the profit target on a trade that you're in. Timo, yes, we look at patterns. As long as the market is good volume, in other words, E-minis, you can look at the trade setups. If you look at overnight, I mean, there aren't good examples here at the moment, but yes, you can have trade setups overnight. In fact, we've got quite a few Australian guys who trade the E-minis, and they trade in what would be the overnight session for US guys, i.e. you guys who are in the US time zone. Right, so are there any other last questions? I think it's been a good webinar today with a lot of detail behind the scene and lots of good questions there, and hopefully it's helped out. Again, it's recorded, so you guys can review that in the customer section of the website if you are on our priority support plan, or if you're subscribing on a monthly or a yearly basis. That's there. So have a good trading week, everyone. We haven't mentioned the war today, because obviously we've been looking at lots of things that over the last couple of weeks as well. So we won't talk about that today, but just have a good trading week. And remember, we're only looking to trade when the picture's clear, and that's defined by support and resistance on our higher time frame DPs. And then you're looking to trade in the direction of that new trend once the hard time frame is clear. And we use exactly the same approach, whether you're trading the E-minis, whether you're trading any Forex charts, you know, whether we've had a look at gold and crude, we've had a look at absolutely everything. You know, all you guys are trading different markets, different time frames all across the world, and exactly the same approach applies to you know, all your different time frame market combinations. Just as long as the market you're looking at is liquid and you have nice, clear, clean swings, that's the main thing you need to be looking for. So have a good trading week, everyone. And I don't know whether I'm going to be doing the a trading session next week. I'll let you all know. I'll put it on the website whether it's going to be on next week or not. I might well have a week off next week. I've got something I've got to be doing next week, so I don't know how the timing is going to work. So there may be a webinar next week, there may not. Either way, I'll update the website on whether there's a webinar next week or not. If there isn't next week, we'll have one in 2 weeks' time. So have a good couple of trading weeks, and we'll be back either next week or the week after to do it all again.